going to try and do over the course of next 1 hour or so is, other than taking your question and answers, we are also going to go through the performance. We are going to go through the budget and what we thought about the budget and what are our key takeaways from the budget. And then finally, we'll wrap it up with a nice session on behavioral finance, where we think there are some lessons to be learned. So without much ado, when you look at Coffee Can, the performance so far, about 16% return on a compounded basis since inception for a fund that has been in existence for almost closer to 6 years now, outperforming the broader markets by a factor of close to 3.7, 3.8%. I know last year was not all that great, largely because the earnings growth continued to come through for us, right? Q1 of FY23, the overall earnings growth for Coffee Can was closer to 38%. Q2 of FY23, the earnings growth for Coffee Can was closer to 19%. But at the same time, somehow there seems to be a correlation which was broken down between earnings growth as well as the stock price performance, largely because when the macro concerns are overarching and they are overlapping everything else, this typically tends to happen. The market tends to take a more value orientation route, and that's typically what seems to be happening right now. But we are making changes in the portfolio. Some of them will be visible to you very shortly. Some of them must have been visible to you already. But we remain fairly confident that this portfolio, which is very fundamentally strong with a negative net debt to equity, with a very strong cash flow position, very steady earnings growth of 24-25% expected over the course of next couple of years, is going to bounce back, and is going to bounce back very, very sharply. The top performers for the month were ITC, Astral, and TCS. And the bottom performers were Avenue Supermart, Asian Paints, and Pidilite. If you move to the next slide, then Good and Clean portfolio registered closer to 3% negative return for the month, largely in line with the broader markets, and the since inception return stands at closer to 12.5%, outperforming the broader market by close to 1.5 percentage points over a long period of 7 years plus. And the top performers for us in this month were Persistent, Emphasis, and Supreme. The bottom performers were Loris, PI, and RT. If you move to the next slide, Ambit Emerging Giants, the small cap oriented portfolio, has managed to deliver close to 15.1% return on a since inception CAGR basis for a fund that started 5 years plus back, and has delivered close to a 6% alpha over the market. Was flattish in the month at a time when the overall small cap index was in the negative, deeply in the red by a negative 2.5 percentage points, with the top performers being Safari, GMM Fowlers, and CCL products, as well as the bottom performers, which were DCB, Garware, as well as Mastech. Last but not the least, the fund that completed 1 year on a since inception basis, Ambit 10x portfolio, has managed to deliver about 1.6% negative return as compared to the broader index, which is about negative 2.5 percentage points. So close to a 1 percentage points alpha over the broader market, was largely in line with the market. And again, the top performers over here being Persistent, Safari, and GMM, and the bottom performers being Metro, Go Fashion, and Loris Labs. So that's essentially what I had to say on returns. With this, what I'll do is I'll invite my very, very good friend Trilok to come and take us through the union budget of 2023 and what he thought about it. Trilok, over to you.
Yeah, hi. Thanks, Manish, and good evening to everybody. So essentially, obviously budget being one of the important event of the year with most investor community tracking it. We also sort of, have our own, takeaways of it. One, we would like to just, think about this budget as a fairly, realistic in terms of both, estimates from a revenue perspective, as well as, expenditure, capex sort of, thrust continues. Essentially, if you look at the budget, the government has, resorted to low double digit nominal GDP targeting, and even income tax, both direct as well indirect, has not been a very, very big bang sort of, expectations in growth. Importantly, government has also taken a lot of off-budgetary items, like for example, IRFC bond raising, or also things like, subsidies which was earlier not part of the budget, has already brought in the budget over the last 3-4 years, which is clearly shows how relevant this piece has been and how credible this budget has been. Essentially, if we think the three broader messages or piece of advice that the government has given, one is clearly they are focused on creating infrastructure, and capex clearly showcases what kind of growth we have seen. This is the highest ever allocation in the budget in capex as a percent of GDP is more relevant because it's almost 3.3% versus 2% for the last decade. Second, obviously, roads and railways thrust continues. Fiscal deficit also kept in mind while designing this whole budget, so that we don't sort of cross the line. And government has also incentivized individual SSCs to adopt the new taxation system. Essentially, the new tax regime, government intends to gradually move on most SSCs to new tax regime, and that probably could be default tax regime in the years to come by. Having said that, currently obviously individual has both the options to go with. And one more important message that I will just leave you guys with on this budget slide is that expenditure this time around, revenue expenditure, which is non productive expenditure, has been curtailed well, and the government intends to create to spend at the right places by creating capex on the ground, and which should clearly be visible across the country when we move ahead. So that's on the broad sort of budget. When I'm moving to next slide, if I look at the key beneficiaries and the sort of segments that had some impact due to budget, I think so clearly banks, autos, chemicals, building material, consumer discretionary had some positive impact in this budget with the various announcements being made. And clearly we have seen government either promoting promoting more credit, or enabling higher infrastructure and manufacturing in the country, be it reduction in custom duty on chemicals, be it in removals in auto ancillary, particularly promoting alternative vehicles, or even for that matter, you have seen what sort of government has done for to promote lab grown diamonds as well. So this is broadly helps the industry. A couple of not so good news for is one of the insurance. Obviously, government has tried to make this a more rational investment opportunity than actually a tax break. So the insurance policy other than ULIP obviously has been curtailed to 0.5 lakhs in a year. So it's like all put together more than 5 lakh rupees of premium in a year for a ULIP. Any sort of return generated from that will be taxable going forward. That's big change we have seen. And also some changes in the REIT and InvIT, wherein we have seen some taxation, basically the marginal tax attraction in some form where the redemption of debt was happening. Earlier it was not taxable, now it is obviously, earlier it was tax-free, now it is taxable. And lastly, government obviously has not resorted to any sort of so-called populist measure, despite the fact that this is a year of, maybe this is the last budget where they had an opportunity to do anything which could appease the common man. So that in that with that words, I would I would conclude that budget is a fairly stable and they have not resorted to anything which will do something pro-populist or pro-voting sort of budget. So with that, I think so I'll move on to the next aspect, and Manish will take us through the behavioral gap, and the impact that will have in the investor perspective.
Thank you so much, Trilok. Now, human behavior, right, and investing. What is it that is the correlation between the two. What is it that we have to learn from over here, and how can the study of human behavior impact our investing decisions as well as our portfolio returns? What are the typical biases, mistakes, I don't know what the correct terminology to be used over here, but they creep in unknowingly, subconsciously, into our investing methodology, which basically limits our overall returns. Now, the point is that as a retail investor, what you typically realize is that 80% of the time we get biased. There are certain kind of biases. Now it could be a confirmation bias, it could be historical bias, something that we've seen before, something that has happened to us before, but we don't even realize it how they impact our investment making decision, which basically means that we keep limiting ourselves and not realizing the full potential that we could have had, right? So what I'm trying to over here say is that when you look at human behavior and the overall return that you can generate, right, versus the return that you eventually generate, the factor that your behavior plays in it is overarching. It's significantly more than what it should have been. When you look at JP Morgan, they published an annual guide to the market, right, in which it was reported that behavior is a single most influential factor in an investment, individual investment, in their success or failure, representing almost a 70% contribution to the overall investor returns. That essentially means that if you are able to identify the correct kind of behavior, if you are able to identify the wrong kind of a behavior, and if you are able to segregate the two, right, and are able to make investments in an unbiased but informed manner, the probability of your return goes up very, very significantly. What I'm going to do here today is take you through a very interesting piece of report which talks about 5 kind of biases that occur when we typically try and invest in anything. The first one is confirmation bias, tendency of people to pay very close attention to the information that confirms their own belief, right? And blocking out everything that contradicts their own belief. Now, which is basically, you've have seen something in the past and you believe that that is something which is going to continue to happen going into the future as well. So anything that tells you contradiction to that, you'll kind of block it out, and whatever confirms it is something that you'll continue to learn. For example, if you feel that spinach is good for health, whatever information that you find online will confirm that belief, that information, that spinach is good for health. But whatever information that will tell you that spinach may not be as good for your health as much as you believe it to be is going to get all blocked out, right? And that's essentially what happens in our investing decisions as well. Now, this is something that not just retail investors do, but this is something that a lot of institutional investors also suffer from. And that's why at Ambit Asset Management, what we keep telling you again and again is that when you're choosing a fund to invest in, make sure that you invest in a fund fundamentally that has a very strong process driven approach and not a very personality driven approach, because confirmation bias is very, very likely to creep in when an individual is an overarching figure and is making all the decisions. Now, I can give you one example over here. Now, when you take, for example, a very leading pharma company called DV's, right? And we've seen the latest results. The stock has been hammered down. The numbers have actually not been all that great. And there has been an element of inherent volatility in their performances. The quarterly numbers tend to vary a lot, right? But at the same time, there are certain classes of investors, there are certain funds that continue to believe that it will do really well in the coming years, right? And they will block out all the information that will tell them that it is not going to happen or may not likely to be happening. They will ignore all management commentaries, they will ignore all the upgrades and downgrades that are happening in the industry. They'll block out all the information that they are getting from on the ground research, but they'll continue to have a very strong confirmation bias, right? So it very easily creates a tunneled vision. And that is why it is very important to have a process-oriented approach, which is very democratic in nature, where everybody has an equal say, where you play the devil's advocate. And when you bring all of that together, this is one part that you can very easily avoid. If you look at the second bias which is basically the FOMO. Now, this is something that I'm sure all of us has suffered at some point of time or the other. Oh my God, this stock has fallen 50%. I should buy it, but you wait it out. You feel that it's going to fall 5% more. The stock starts moving up from there onwards. It moves up 20%, and the FOMO becomes so strong that you end up buying it when you probably should not have, and then you end up making a loss, right? So the fear of missing out, or FOMO as the new generation calls it, is a fear that investor feels when he's missing out on a potentially lucrative investment. You did not buy it, but somebody bought it, or somebody who knows somebody else who bought it, and because of that he made X or Y amount of money, but you feel that you've lost out, so you end up jumping late, right? This is essentially the bias that we call, which is basically fear of moving out. And this is a very popular bias. It is probably one of the most popular biases, largely because of three reasons. One is that investing easily is accessible to the masses. You're traveling in the local train, you are traveling, interacting with people over a dinner, in a party, and you realize everybody's investing and they've all made money here, there, somewhere, right? This also comes in because nowadays you have apps which are easy to use, and the noise that is created in the media, which is basically that so much lakh crores were lost by investors in a certain stock, or so much lakh crores were made by investors in a certain stock. Now, best example I can give you of fear of missing out is the IPO of all these new age companies that had happened, right? Now, at that point of time, there was a mad scramble by everybody to invest in Nykaa, to invest in Zomato, across the board, all these new age companies that were there at that point of time, everybody was just running and scrambling around to invest in that. And the maximum amount of question that we got asked at that point of time was also this, that why are you not investing in new age companies? What has happened? You'll miss out on this. There's a great lucrative opportunity. And you look at 2 years down the line, what has happened to all these new age companies and what has happened to their stock prices and where they are today, and you realize it's good that we did not suffer from FOMO, and it was good that we actually were able to eliminate this bias and stay true to the philosophy that we bring to the board. The third one that I'm going to talk about today, the third bias, is basically the anchoring bias. Now, this is an irrational bias that basically occurs when you are anchoring towards an arbitrary benchmark figure. Now, this is typically seen in investing when we value a stock on based on what we paid for it, right? The price relative to a specific event. It could be an all-time high, it could be an all-time low, rather than paying attention to the business fundamentals, right? Now, when you look at, for example, a stock, I can give you an example over here, is DMart, right? Now, often you'll get asked is that, where do you think DMart will be in the coming 3 months? How would you approach this stock? What will be the investment rationale over here? And many people would first say, oh, did you look at the stock today where it is? It's at a 52-week high, it's at a 52-week low. And your investment decisions are based on that whether this stock is at a 52-week high, whether it has done well, whether it has not done well. And they're going to completely ignore, right, what is happening on the fundamental side, and whatever assumptions they make on the fundamental side are also going to be based on this information in terms of how the stock has done. You look at the chart on the right hand side, this basically tells you a correlation between equity flows and Nifty returns. Right now, you look at equity flows on the real-time basis, but next year's equity inflows. Right now, whenever equity markets have done badly, the subsequent years Nifty inflows have fallen, and whenever Nifty has done well in the subsequent year, Nifty inflows have actually risen substantially. This is a very perfect example of anchoring bias. When you should have been buying in 2020, people were actually pulling money out. And when you should have been booking profits in 2021 and 2022, people were actually pumping in money into the equity markets. Factor number 4, the fourth bias that we typically suffer from, is herd mentality. Now, herd mentality typically happens, when everybody en masse is rushing towards something. Now, it could be a dot-com bubble, it could be the real estate bubble, Somebody in the comment section mentioned about crypto markets, right? That again was a little bit of a bubble over there, right? Now, this is a typical herd mentality example where everything becomes a fad. There is a certain fashion that comes at that certain point of time, and everybody rushes in to invest in those. It could be a new age company IPO also at one point of time. Even one of the worst companies that you could think of, which was accused of fraudulent practices, etc., and were on the verge of bankruptcy, achieved unicorn status and were actually very seriously contemplating coming out with an IPO. That's a very typical example of herd mentality. And the biggest herd mentality example that I can give you from our portfolio perspective is Asian Paints. I've been tracking the stock for close to 16 years now, 17 years. And at any given point of time, from 22 p.m. multiple to 70 p.m. multiple, the only thing I've heard from people at all points of time is the fact that this is an expensive stock. I'll wait for the stock to correct a little bit. I have a fair value range. If it comes there, then I'll buy it. And typically 90% of those are the people who actually miss out on making money in Asian Paints. The stock has actually gone from being a $500 million market cap company to a $35 billion market cap company. It has been a 70 bagger over a period of 16, 17 years. But typically, an average investor that I have met, 8 out of 10 of them have always told me that it's an expensive stock at all given points of time. When in fact, fundamentals of the company will tell you that there has been a 13% CAGR profit growth in the business over a 10-year period. Very few Indian companies have been able to achieve this kind of a number. If you move to the last point that I have, which is basically the hindsight bias. Now, we are all always very, very wise in the hindsight, right? It's a psychological phenomena that allows you to convince yourself after an event has happened that you had actually accurately predicted it, that is going to happen this way, right? The best example I can give you over here is PSU banks. Now, last year in the second half, PSU banks started running and they ran up in a way that we've never seen before. Something like a SBI achieved a price to book multiple of close to 1.7x. The P multiple expansion was huge. Private sector bank last year gave you a return of close to 24%. PSU banking index gave you a return of close to 80%. And the only question that I got asked at that point of time, the only question we as an asset management company at that point of time got asked is, why are you not investing in PSU stocks? I always knew that they are going to. Now, whether you're holding it in your portfolio or not is going to be irrelevant. But the point is that you're always going to be wiser in the hindsight. And that is, again, something that is an anchoring bias. That is, again, a hindsight bias that you need to eliminate from your psyche. So what we are trying to tell you over here is that human behavior is very important. It is something that you need to understand and study to remove these biases, to be able to make a fruitful decision into your investments and maximize your return. And that's the endeavor that we are constantly trying to make here in Ambit. So that's the presentation we had for you today. If you